Hello, everyone. Welcome to the first video of Chapter 9, Module 2 for this course. We're going to be talking about other income and deductions. In the previous course, we would have talked about source income, employment, business, investment income. Other income are income inclusions that are specifically outlined by the Income Tax Act. I'm just going to share the screen. We'll get into our first lecture. So when we talk about other sources of income, they're usually dictated by subdivision D. If you recall from tax one, there's this section 3 method when we were learning about calculating net income. Now, the three first ones that we usually deal with are our sources of income. These are continuous and reliable, and there's a profit motive. Other income is usually these specifically stated income types that should be included in our income for various reasons. So, this subdivision D determines whether taxpayers are in receipt of specifically described amounts. If they are receiving amounts specifically outstated by the subdivision, they are going to be included in your income, even though they might not necessarily fit the usual source test for income. So this includes scholarships, spousal support payments, and the Canada Emergency Response Benefit, which was provided a few years ago. So spousal support payments are continuous, but they're not by virtue of labor or capital. They're by virtue of a relationship, or at least an existing relationship between a former spouse. Along with subdivision E, you're also allowed to take specific deductions to reduce your net income. Now, often you need to qualify for these specific deductions, and this chapter will have several calculations on if you are eligible for a deduction, how much can you take? So, rules that set out how certain transactions, events, and circumstances change income tax outcome. So, reasonableness of expenses, the 50% limitation on meals and entertainment, non-arm's length transactions, transfer of property between spouses. So, these income tax act sections are kind of going through the variety of expenses and deductions a person might have and trying to set out. I don't want to say set out rules for fairness, but rules to try to catch when deductions are for a personal benefit compared to when they're for business. So, for example, 50% limitation on meals and entertainment. If I'm running a business and I take a client out for a meal, it's expected that the food I'm eating or the entertainment I'm enjoying is a personal benefit. I'm paying for their meals and entertainment in order to garner the relationship, perhaps, finalize a sale. So instead of going through all the receipts of, well, which dish did I have, which dish did they have, they just say tally up all the meals and entertainment and we'll use 50%. So they're trying to establish this, um, trying to separate personal benefit from an actual expense deduction. Non-arm's length transactions are trying to look at transactions between me and people who I have a close relationship with. Easily identifiable in this are family members. So I may be partaking in transactions that from the outside look like the transactions are intended to be saving me money through taxes. So they're not legitimate business transactions, they're more tax arrangements with family members. The family as a whole is benefiting from the tax deduction, even though I might not be the one getting the money. Perhaps the money is now going to a spouse or to my child. So we will be discussing rules around non-arm's length transactions and transfers between spouses. There are other types of income in subdivision D. We have pension benefits. Pension benefits, I'm no longer employed from a position, so I don't have continuous labor, but I'm earning pension or at least receiving pension by virtue of previous labor, my previous employment. Now, it's not just the pension I get through work. Perhaps I have my own pension account, or my own savings account reserved for my retirement, or I'm collecting CPP and OAS, or my foreign income could be coming from a pension from another country. So pension benefits, because they don't fit the source test, are specifically stated what needs to be included. Along with pension benefits, when you leave a job, you might receive a retiring allowance. A retiring allowance is um, when someone retires, their work might, as a show of gesture, a show of thanks, if they don't have a pension plan in place, they might provide some sort of bonus amount. So that covers most payments on termination of employment. If the retirement relates to employment services before 1996, the employee is allowed to transfer part to their RSP. So what that's saying is I've received this benefit because I've been working someplace for a very long time. 1996 is 30 years ago. So since I'm getting it by virtue of being with the company for a long time, then I could take this lump sum payment and a portion of it might be able to go into my RSP. So the payment will be fully included in income, but my contribution will allow me to deduct from it. Deduction can be claimed for legal fees paid in year for purpose of either establishing right to a retirement allowance or its collection once established. So if you feel you have a right to an allowance, maybe your work customarily gives one and they didn't give one to you, and you have legal fees in order to claim it, those can be deducted from the pension allowance, the retiring allowance, because it's an expense directly related or correlated to receiving that income. So Jennifer retired in September 2024, received a $75,000 retiring allowance. She was permitted to transfer $15,500 of that amount to an RSP. She made the contribution in February of 2025. So in September 2024, $75 gets entirely included in income because of Tax Act Section 56. The $15,500 deduction is allowed because of Tax Act 60, where it identifies specific deductions. Now, for RSP contributions, which we will talk in much more detail later in this course, you are allowed to deduct contributions as long as you make them within the first 60 days of the year. So since the contribution was made in February of 2025, that's early enough in the year that we can subtract this amount from our 2024 income. So the person, Jennifer, will add $75,000 to their income because they received that much money. But because a portion of it went into this pension account, they're allowed to subtract from their income that portion that was contributed. The Income Tax Act or an income tax return treat the inclusions and deductions separately. Often, when discussing these things, when I'm talking about tax effect, you might find me netting them to each other. So I say, okay, total net income is 59,500, but on the physical tax return, we would put these in two different places. There's a section to include it in total and net income, and then another section to derive our taxable income. Now, when you pass away, you might have paid out for you a death benefit, means the total amounts received by a taxpayer in a taxation year on or after the death of an employee in recognition of employee's service. So I've been with a company for a long time. I've passed away as a thank you, or perhaps as a way of helping out my spouse for being a long time employee. They might take what might have was going to be my retirement allowance, and perhaps they'll pay out to the spouse as a death benefit. So this will be included in net income of the individual taxpayer who's entitled to receive. So if they pay out the death benefit to my spouse because my spouse received it, it's going to be included in their income, even though it's related to my employment position. The first $10,000 of the amount is exempt. The surviving spouse is given priority for exemption before it can be used by another person. So if the amount gets broken up, say a little bit, so it's $20,000. They give $5,000 to my spouse. If I have three children, the other 5,000 gets divided amongst the three of them. Then, so because each of them have gotten 5,000, the first 5,000 will be given priority to my spouse. So the amount my spouse received will be exempted, and then the rest of the exemption will be spread over the other three. But the surviving spouse is given priority because much of tax law is mostly about transferring properties to spouses, especially at time of death. It helps protect those income amounts so that the surviving spouse has more available to, continue to live the life they used to live. Now, this is different than the CPP death benefit. When you pay into CPP, you have a right to a certain amount of CPP payments, and when you pass away, they will provide $2,500, and I believe it's meant to be sort of assistance for, dealing with the death, the funeral payments and arrangements. So $2,500 to assist with funeral expenses included in net income of estate. So the usual death benefit gets paid out or gets included in the income of who received it. The death benefit, because I've passed away, the death benefit might have been received by a spouse, but because it's in my name, it's going to be included in the income of my estate. So it will have the estate, the will have taxes paid on it by the estate, and then my spouse as a beneficiary of the estate will then be tax-free. Um, so the Tax Act 56 that discusses death benefits does not apply to a CPP death benefit since it's not paid in recognition of employee's service. So this section 56 1A3 is different than A.1 because this death benefit is related to my employment, whereas this death benefit is sort of related more to my CPP contributions in my lifetime. There are other general inclusions. Deferred income plans, RSP withdrawals, deferred profit sharing plans, RIFs, home buyers, and lifelong learning plans. So these are various income inclusions that are usually related to a deferral of income. When I contribute to my RSP, that amount is going to be subtracted from my income. So I'm not going to pay taxes now, but I will pay taxes when I withdraw from the account. Deferred profit sharing is the same way. The company I work for makes profits. They have a sharing plan where it will accumulate in an account. So I don't need to pay taxes on that amount, even though I have a right to it, until I physically withdraw it. Home buyers plan and lifelong learning plans, again, I believe we get into this in the next chapter, is I can withdraw certain amounts from the RSP account and I don't have to include it in income as long as I'm paying it back to the account. So those home buyers plans, it allows for like a loan against the RSP withdrawals, and as long as I'm making the payments, it won't be included. It's only the amount of payments I'm failing to make, the repayments that I'm failing to make, that will be added to income. Scholarships, fellowships, and bursaries. These are often associated with academic pursuits. You can get a scholarship to help pay for tuition if you're in a program. So these amounts are included in net income if they exceed certain exemptions. In most cases, the exemption equals the scholarship. Scholarships have a tendency to be tax-free or exempted from income as long as they're related to an education program for a qualifying student. And qualifying student, do we go into the qualifications? I think a qualifying student has to be a full-time student in a Canadian institution, a Canadian educational institution. So, an elementary or secondary school education program, individual enrolled as a full-time student in a qualifying education program at a designated institution. The designated institutions are mostly Canadian colleges and universities, but I do think the list does have a handful of probably um, reputable or well-known American universities, and I think a couple in the UK. So it's supposed to be I'm receiving these funds, but these funds are directly related to an education I am getting. So it will be exempted from income to sort of benefit students. Now, I might get a research grant. I work for the school. I have a research project. The grant will be included in income, but I'm allowed to subtract from that grant the expenses and costs related to the research it applies. So I have a project. I want to research a certain idea. I submit a research application to the government. They provide, say, $50,000. That's income to me. I've gotten money, and that it would, for the time being, that could just be my income while I perform the research, so they're paying me. But if I have certain costs, maybe I need materials, testing facilities, labs, so I'm paying rent. So that money's not staying with me to pay my, my apartment or for my groceries. that money is being used to pay for the research itself. So because the expenses mean that the amount spent is not a personal benefit, I don't need to include that amount in income. Only the excess number of monies received uh, over the research costs. We also have social assistance and workers' compensation. So low-income individuals or individuals who were hurt at work might be receiving additional payments through government programs or through workers' insurance programs. You still need to include the income so that you can report it to the government because it's included in net income because net income is used to determine eligibility for many social assistance or government benefit programs. So if I'm receiving benefits from a number of social programs, that income will all be tallied. I will report it in my net income so the government can be aware of how much I'm getting. And so if I'm getting too many programs and my income's over an eligible amount, then they might pull back some of the social programs. So they include the social assistance and the workers' compensation to get an idea of the big picture of how much you are receiving. Perhaps I've started working and I don't need the social assistance as much. That will be identified in the net income. They only want to include it in the net income to determine those eligibility parameters, but they don't want to tax you on the aid the government's giving you, so you will then be allowed to rededuct it from taxable income. So if an individual receives $60,000 of workers' compensation and no other income for that year, their net income will be the 60,000 received, but taxable income will be nothing. Their income is basically a type of insurance payout that's going to be non-taxable. They just want it reported. Other deductions, subdivision E deductions. So subdivision D is where we're talking about our various inclusions. Subdivision E is what we get to deduct from our income. So CPP contributions on self-employed earnings. When you have CPP come off of your paycheck, that CPP, the amounts paid, are covered for you in terms of a tax credit. You don't get to subtract it from income. However, in recent years, they have this sort of two levels of CPP. So up to 68,500, you're paying the regular CPP. Above that amount, up to 73,000, so like another $5,000, you're paying what's called CPP2. It's an additional Canadian pension amount that you're paying. So the regular tier, that first tier, is just included in the tax credit. But if you're making enough money that you're paying that additional amount, that remaining amount is being deducted from your income. So if you've paid the maximum amount of CPP, both tiers, for most of it, you'll be getting a tax credit to account for your contribution. The rest of it, that small amount, will be subtracted from your income. So it will show up on two parts of your tax return. When you contribute to CPP, your employer has to make a matching contribution. Now, this matching contribution is considered part of their business. It is a business expense, so they will be allowed to deduct the full amount from their business income. And that's important to to be aware of because if you are a self-employed individual, you need to be paying both parts. I run my own business, so I'm paying the employer portion, and I'm also, trying to pay into CPP myself as an employee. So I will pay both parts. So a self-employed individual could pay up to just over $8,000. So that first amount they pay that an employee would pay is a personal tax credit base. The second part is a deduction under Income Tax Act 60 for E.1. And then the rest of it, the employer portion, gets to be deducted from income in the same way that any employer would be deducting it from their business income. So you'll be able to deduct the full employer portion as part of Income Tax Act 60, Subdivision E. Um, Yes, so we're going to stop the video there. When we come back for the next video, I'm going to go into a larger calculation for subdivisioning deductions, which is moving expenses. Moving expenses and childcare fees are big subjects in this chapter, at least in the early section of it. So I want to give enough time in its own video to talk about moving expenses, and then video 3 will be childcare costs. So thank you for your time. I'll see you in the next video.